I'm Keith McCullough, and welcome back. Thanks for spending some time with us. Obviously, that Hugh Hendry conversation was provocative and is going to get a lot of questions, at least stewing in the community. This next guest is one of my favorite people in the community, Wall Street community at large, is Mike Green. Thank you for making the time, Mike.
Oh, absolutely, my pleasure, Keith.
I don't know if you saw any part of that Hendry conversation. Did you, by chance?
I did not, but I really wish I had now. Unfortunately, I've been rushing around Lower Manhattan, getting ready to head off to another conference right after this. So,
well, he's a guy, as you and I grew up in this business, was quite provocative all the time, right? He's writing, and you'd get his letters sent to you when he was running his fund, and he going back to 03 when he launched it. I didn't know that his first big call was to get long gold, but his go anywhere strategy is something that I've always appreciated, and certainly what I appreciate about you. You can go anywhere on any topic. You have a specific process. You have a specific lens by which you look at the market, in particular the options market. I did go with Hugh down that rabbit hole a couple times, but maybe just so we can level up and give people who aren't familiar with you or how you think about markets and market structure, just give them a top-down view of what's happening in gamma space or option space in particular. Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there, subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.
Sure. So just very quickly, my background is in the option space. I actually managed portfolios for years in the hedge fund space. In the past 2 years, transitioned over to ETFs with a regulatory change that allows us to use options. And at Simplify, kind of what we're known for is offering traditional beta type exposures using option overlays that take advantage of what we think are distortions that occur in the market. What's happening right now in the options market is absolutely fascinating. So there are two really primary components that are going on. One is that the dealership community has effectively consolidated and collapsed. There's really only a few major option market makers left. The second thing that's happened has been an explosion in the use of very short-term options. And short-term options have a unique characteristic to them that is very much like playing a gambling game in Vegas, right? You can go from being in the money and the option having value to being out of the money and the option having no value almost instantaneously. And so when you see these statistics that show the explosion of calls or the explosion of option contracts that are being traded, both puts and calls, what you're actually seeing is an explosion in the number that are being traded because they're so short dated, so little premium is actually being spent on them, that they're effectively, flips of a coin that are being tossed out by, I'm not going to say the retail punter community, but in large part by market participants who are trying to play in a market that is increasingly frenetic. That characteristic, that very short-term dynamic of being either in the money or out of the money, is what is basically a property of what we call gamma, right? Gamma is technically the change in the delta of the option, or the delta hedge ratio of the option, that occurs per 1% change in the underlying. And so if the S&P goes up 1%, an option that is at the money will have a delta somewhere around 50, meaning it represents half of a share. If that option is very, very short dated, a very small increase in the price of the S&P can cause that option to become effectively the same as a share in the S&P. A very small decrease can cause it to become effectively worthless overnight. That characteristic is all over the market right now. And it's, in just the simplest term, it's causing all sorts of, very aggressive behavior from the dealers who are forced to chase this change in delta. Dealers don't really want to express a point of view. You call up your broker, you say, I think Apple's going up. I want to express it by buying a call option on Apple that expires next Wednesday, that is 1% out of the money. And your broker, obviously, you haven't called them up. You've done this, in an online broker format. Nobody cares about the actual underlying direction. The dealer is going to hedge out that exposure. If you're buying at 1% of the money, they're going to buy slightly less than one call of Apple for every option that you're buying to offset their risk that Apple could go higher. as Apple falls because you're terrible at stock picking, they're going to join you in selling shares of Apple because they no longer need to hedge as much. And that explains a lot of the intraday moves that we're seeing, these extraordinarily volatile moves where the market is up 1%, then down 1%, up 3%, then down 3%. A lot of that is being driven by dealers hedging their books in increasingly thin markets.
That is that's a perfect tutorial for people, and you did it in professional style, which it didn't take you very long. So I want to go through at least three. Let's go knock down 3 pins first. Let's go through how narrow that dealer community is and color that up a bit. Talk a little bit more about YOLO short-term options, and then these gamma moves within the context of what I call the machine, or the broader trending factor-based moves that, in many cases, gamma squeezes are occurring in the opposite direction, which is entirely why there's so many opportunities. But first on the dealer community, so it's collapsed. Part of it now, I think can we just talk about who the players are? Ready player number 1, ready player number 2, and maybe introduce where there are some firms are on both sides of the trade actually as well.
Yeah, so if you go back pre-2008, basically every brokerage firm, every major investment bank had significant prop trading desks that would function in these types of market making opportunities. I actually started my career working for a firm called Spear, Leeds & Kellogg that was one of the market makers, one of the largest market makers on the New York Stock Exchange, did regular business in options, and is now part of Goldman Sachs. And candidly, if I look at the market for option market makers today, it has collapsed to basically player 1 is Susquehanna, player 2 would be Citadel, player 3 would probably be Goldman, and then it gets very thin.
Yep.
Right. And so part of the reason that becomes really important is if you actually think about the dynamics of those 3 players having a near oligopoly, it means by and large that they control pricing. Their books are very, very large. So the behavior of any one individual tends to be matched up against a lot of other players. The ideal for a market maker is that they simply cross a trade in between 2 customers, right? I call and say I want to buy. You call and say you want to sell. We cross the 2, we take a bid-ask spread, and we go home without any risk, right? That's the ideal scenario. But that tends not to be the case. And so, if I want to buy and there's nobody else out there, they're forced into this delta hedging dynamic, which we were describing before. As they get larger and larger and larger, the impact of those single players hitting the broader market, the S&P futures market, the individual stock markets, market for individual stocks, those begin to impact markets in a way that we just really haven't seen before. And it's exacerbated by the loss of those prop desks that would have historically provided depth on the risk-taking of the broader market. It just doesn't exist anymore.
Right. I mean, some of these options trades that go up blow the mind, and they just continue to blow the mind, so your mind shouldn't be blown anymore because it's the game now. How much of that, sometimes I'll tweet, and as you know, in options relative to Mike Green, for everybody who doesn't know, I'm like a complete neophyte. The guy can forget more on the way to the bathroom in terms of how this all works relative to what I know. But I do trade like a degenerate, like most people out there. I do trade options aggressively and actively. So, and just watching the flow, it's like, holy shit. I mean, for example, coming, I think it was out of Monday and Tuesday, you get the big lift, everybody's buying the Tom DeMark signal, it's oversold, we're going to have a big rip, and that's kind of like, if you faded that, you did well. But it was actually on the Wednesday, I think it was Wednesday, intraday, where I may have the day wrong, but at 12:30, somebody slaps 4 billion notional on a strike. It's like the whole tape lifts, on an S&P. But nothing else moved. Nothing else in macro moved. Credit didn't move, currency didn't move, nothing. And I'm driving in the car and I'm getting my clients, that's when my phone, anyone who has our institutional clients who have my text, they just lighten me up. And I'm like, I don't know. I mean, what do you think about that?
Well, I mean, again, part of it is, ironically, the shorter dated and the less premium that gets spent on that option, the more important it is that the market makers get out there and hedge that price immediately, right? They just can't take the risk that, whoever this trader is, right, and somebody dropping $4 billion or $1 billion worth of notional, knows something, right? But the actual premium on that could be quite small, right? So $1 billion notional premium on a 1 week option, again, I don't know the exact trade. I do remember the one that you're talking about, but that could very easily represent, maybe $2-3 million worth of premium that was actually spent that could be used quite effectively to hedge a very large book, precisely because they bought so much notional.
Right.
For the dealer, they just want that risk gone, right? And that's why they're so good at it, right? They have direct access to the exchanges. They have direct access to the black pools. It's the reason why totally blanking on Ken Griffin's for Citadel, pays for order flow, right? They want to get as much liquidity. They want to get as many transactions as they possibly can in their market making operations, so that they can execute against this without ever touching the exchange in many situations, right? So that's their objective. It's not to, trade ahead or figure out what some our Wall Street bets, crew is trying to figure out.
I mean, it's not. It shouldn't surprise anybody. I mean, if you have visibility on order flow, and you understand how the machine works, then why not? I call them bully orders, but I mean, because I'm personally getting bullied, right? Especially, I've been wronged. I'm on the wrong side of that one because you don't know when it's coming. But it's or it's great if you're on the right side of it. But what do you think about using that word, bullying the options market?
Well, there's two ways that they can bully it, right? And so again, remember, when you have a near oligopoly, you can basically play off two vectors. You can play off price and you can play off market access. And so you actually will see this. If you look at the holdings of any company at a point in time, you'll see, and those of you who follow my work know that, immediately you're going to see the largest holders are going to be Vanguard or BlackRock. And then below that, you're going to often see a Susquehanna or a Citadel, et cetera. That's not their hedge fund operations. That's their market making operations that are delta hedging very large option positions. And so when a call option, a series of call options have moved into the money, for example, a meme stock has risen significantly, you will see that Susquehanna or Citadel becomes large holders of these companies, right, of the equity in these companies. Why is that happening? Because they're delta hedging their exposure, right? It has nothing to do with them validating. The stories that we all hear about this at this point are just absurd, right? Citadel's buying alongside us. They're trying to get our shares, or, blah, 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 blah. Like, none of that's true. It's just market making operations. And again, because they have become so large and the market is so small, they have two ways that they can hit that. One is by raising prices. So we've seen this repeatedly over the course of this year. In many of these meme stocks, you're seeing the implied volatility of the stock explode north of 400 or 500%. In some cases, I've seen it start to break the Bloomberg screens because they can't handle enough digits. It just sounds insane, right? It's like gas prices going to $10, right? The infrastructure is not set up to handle it. When you have that sort of setting, what's actually happening is very small players, right? Roaring Kitty or somebody off of our Wall Street bets who's probably thrilled that I just mentioned his name. But the dynamic of them playing on a Robinhood platform where they're buying the quote unquote cheapest option, which means it's a 5-cent option that is 30% of the money expiring next week, right? Like, that option has just a ridiculous implied volatility, and it's at 5 cents not because it's worth 5 cents, technically, but because they can get away with it.
Yeah.
They can price it however they want.
Well, let's spend a little bit of time on that. That was the second pin, which is the YOLO component of the game. We'll come back in the third part, which is delta hedging, institutional. I think that this is a really one of the more fascinating things that we can talk about is the interaction between those trying to run massive neutral hedge funds and constantly delta hedging them in this type of an options environment. But that's institutional. There's two components I always write about it. I always say there's the FOMO retail investor who loves trading YOLO short-term options, and then there's panic and performance-stricken hedge funds who are trying to deal with the other part of that, which we'll come back to. But on the YOLO piece, how much of, and I think, to me it's a bubble in terms of like just activity and behavior, but so I'd love to hear your comments on that. But how much is that a function of, one, no commissions, and two, the short-dated strikes? This is the macro show. This is pregame, okay? We're trying to play the game that's in front of us today, trying to give you all the content so that you can see that there are many tools in the toolbox to play at the highest level. You know, leadership matters at Hedgeye, so again, being transparent, accountable, and trustworthy people. This is a game about playing and weighing probability. It's not about picking stocks. It's about picking the right portfolio. Execute across everything. Don't get distracted by the MSM and the tourists. They're very dangerous. I will grind and execute for you with our people and with you.
The short-dated strikes are much more important, in my opinion, than the lack of commissions, right? And it affects everybody in the industry. We see this within the hedging that we do. We're often, because of trying to maintain a certain hedging budget and trying to maintain a notional exposure, we can be forced into short-dated options, right? Mm-hmm. Particularly in the elevated volatility environment that we currently find ourselves in. So I would suggest that the short-dated component actually plays a larger role than the lack of commissions today. If we go back to 2021, in the pandemic-inspired environment, absolutely, the Robinhood phenomenon was huge. It was absolutely incredible to watch this go. And it makes perfect sense what happened, right? I mean, payday came, everybody got extra money, they went to the casino, they spent their money, and when no more money came, it started to die off, right? And I would argue that we've already been through that phase. Most people tend to forget that the, Cathie Wood, Dave Portnoy type stuff began to die in February of 2021, right? We're now 18 months past that point, and we're still kind of talking about it because it was just so shocking and memorable, right? Actually, 20 months past that point. 2022 is flying by in a blur. So I would actually focus people more today on the dynamic of the short-dated components,
right,
and the need to limit the spend that you have, right? Now, that does absolutely create problems. It creates issues in terms of what we're seeing in terms of the high quantity of gamma in the options, so that things are either in the money or out of the money. It also raises risks from the institutional standpoint of how well hedged is your book actually, because it has tremendous path dependency associated with it.
Right.
That becomes a very significant issue.
Well, I mean, in a lot. I was just looking up the chart just to make sure that I had the timing right. And I might have the week or day off, but these are moments in time, like where Tesla, for example, short-dated options. I think one day it was 44% of single stock options were in were in Tesla, and it was in August when we were in the throat of that, really the last part of the bear market squeeze to lower highs, and of course Tesla, which is like 20% of the XLY, and you kind of go through how that flows into the rest of the machine. Wow, I mean, those things really, really matter.
Absolutely, and it's exacerbated again by the general lack of liquidity in the market. I mean, again, I've talked about this elsewhere. But if I go back to 2010 and I would try to do a trade of $1 billion, that might move the S&P by a few ticks, right? Yep. Today, if I try to do a trade of $10 million, that could move the S&P a few ticks. The liquidity is just a fraction of what it was. Markets have gotten much worse in this context versus better.
Well, let's bring it to the third pin, which is knocking these three down. To me, this is the most important one when it comes to the discussions that I have more and more frequently with institutions. Is, okay, how is this really working, and how, most importantly, do I pick people off, fade this, make money on it, right? Because what's happened is that more and more people are hostage to it, and they don't have a really good, they don't really have a good process. They trade on emotion. They see these moves, and like to your point, it's like, why? It's always got to be fundamental, and it's just flow, So, when we look at it, guys, if you can pop up slide 4, this is like always like one of the first slides in my process presentation, Mike. I don't know if you've seen this, but it's just showing you the investment landscape, which you're front center at now with Simplify, obviously, because I'm showing my former self, or your former self, my former life. When I started in this business in 2000 at a hedge fund, the blue line, which is global hedge funds, in terms of AUM against ETFs, one would dwarf the other. So what you really need to know was, what block was Steve Cohen going to trade next, right? So that was the flow. You wouldn't have to know, okay, Peter Dartley over there at Pequot, you got this flow coming out of SAC, the sell side. That was the game that I was taught, right? Options weren't the factor, not even nearly the factor that they are today. Now today, fast forward, and you can see the blue line is now below the gray bar, and we're north of 6 trillion in AUM on ETFs. So you also have I guess the dynamic now is that you have a lot of hedge funds that don't know how to short stocks. So they're constantly, their hedge or trying to be neutral or trying to be hedged at all is in the ETFs.
Right.
So when when we just state that, if you disagree with my my contextualization of the machine or the game, then say so. But away from that, what I really want to know is the right way to play the game to take these 1 to 3 days in a month. It's I'm generalizing, but 1 to 3 days in a month where there's a gamma move, and which is generally counter trend. Like last year, in a bull market, the moves were to the downside in equities that you could have capitalized on, bought the damn dip. This year, it's always sell the rip. Yep. Is that the point? Is that your gamma is going to be counter to the trend, and if you can stay in the 1 to 3 day windows and not ask too many questions why and just execute, that's the answer or not?
Well, I'm not sure that I would narrow it down that exclusively, right? I mean, there are two separate games that are being played here. There's a trading game, and to the point that you were making before, even the trading game used to have more of a fundamental bias to it, right? It would be, okay, who are the smart players? Who's building a position? What can they know, et cetera? I would argue that increasingly that is taking a backseat to the very simple flows of, who are the retailers trading into, and so people track, who are the big movers on Robinhood or the trending stocks on Robinhood.
Right.
Many hedge funds have tools out there now that monitor and scrape effectively the message boards for that type of stuff. And people intentionally try to take advantage of that, and so it becomes the endless game of, do you know what I think you know, and if I know what you think you know, blah blah blah. It's just ridiculous. My Twitter avatar is the character Vizzini from The Princess Bride, right? Are you the man who would put the poison cup before you, right? So we're in that component to it, and I would argue that the hedge fund world was much more fundamental back in the day, which is when I got started as well. The dynamic of gamma squeezes, I think you hit on a really important point, right? Which is markets tend to trend, and as they trend, options will either go into the money or out of the money, right? And so if a dealer, going back to the example we gave before, has sold calls on an individual stock or sold calls on the S&P, and the S&P is trending upwards, they will be buying those call options, buying stocks underlying that to match that, right? Exacerbating the move. If you buy a call option, right? So you're super enthusiastic and you buy a call option from the dealer, right? Then all of a sudden you're bearing most of the risk in terms of that component. If you sell an option to the dealer, right, effectively buying a put, so the real risk is things go down, for example, right? Or you're short volatility. I'm sorry, let me rephrase that. In 2021 or 2020, if you had decided that you were going to harvest option volatility and short it, right, looking at the world and saying it couldn't be more perfect, you effectively are bearing all the risk of insurance. That leaves the dealer in a very, very comfortable position where they're able to say, I'm going to exploit them holding insurance. If on the flip side of it, you're basically gambling and speculating, right? The dealer has to be super, super aggressive in that. And so I write a daily newsletter with a group called Tier 1 Alpha that we put out exactly on these topics, referring to dealer positioning, what's called positive gamma, negative gamma, et cetera, tracking the overall positioning both against the market and increasingly against individual securities. I want to emphasize that by far the most important market in terms of those types of analyses are the S&P 500, right? So if you understand kind of the general positioning of that, you're going to get a great picture of what most of the optionality or what most of the behavior looks like. Throughout 2022, what we have seen and the latter parts of 2021 is we have increasingly seen the holders of underlying securities, right? Somebody who is forced long into the S&P simply by virtue of their mandate. I'm a good example of this. I run strategies that are long the S&P and then hedge those portfolios by buying options, put options. We're basically sourcing insurance from the market, right? We want the market makers to provide us with that insurance they have to go out and delta hedge those positions. Because 2022 has been much more about the bear market, you're increasingly seeing people say, I don't want to provide insurance to this market. I'm scared of the risk of a crash. Therefore, I'm going to hold my stocks, but I'm going to hold them in a hedged framework.
Yep.
And that absolutely creates the dynamics you're referring to. The market will trend in the general direction of the economic environment, and that people are trying to express fundamental points of view. But occasionally, the dealers will be caught offside, and the market will start to rip higher, and they're then forced to scramble. And the shorts that you mentioned are also then forced to cover, right? And we've seen this over and over and over again in 2022, where the bear market rallies are far more vicious than the sell-offs. They're far more vicious than what we've seen in terms of most of the rallies in 2021. And again, it was one of those things that those of us who have done this for a long time looked at the meme stocks. And I would argue that a lot of people misinterpreted that type of behavior as fundamental in nature, right? Telling you something about the validity of the underlying thesis or business model of these securities. And it couldn't have been further from the truth, right? These were very simple short squeezes exacerbated by retail participation in options.
Yeah, if you, if you just go back to simple points in time, and this is my point, because I call our process a full investing cycle process, which means that if you're on the right side of the inflation and real growth trend, over time you're going to generate alpha. Now, the opposite of that happens in these short-term windows. I was just looking at my notes in terms of like on October the 5th, for example, there was a huge squeeze. And Goldman, interestingly, they're of the three that you obviously named in terms of dealers. They're also like they've created and perpetuate what I call these bear shit baskets, right? Like quite literal. Like for this quad that we're in, it's the biggest crap that you could own, which would include, the number one mover that day was the Goldman Bitcoin sensitive basket, and then followed by, the Goldman profitless tech basket, like the Goldman bear shit basket,
the
whatever.
The diagram of those is very closely related, by the way, but yeah.
But you can see, I have clients are great with me, and I could see it on my Bloomberg. You could see you punch it in your Bloomberg. Just watch these baskets. They quite literally perpetuate the gamma. I mean, they're up and down. I mean, it's just and it's a circuitous like path, right? Like I'm the dealer, I got the baskets, but the dealer has to behave a certain way, and then when the basket behaves a certain way, I show all the clients that behavior, and then they freak, and then it happens faster, and then it ends. Like if you go, just back to the 5th of October, if you did the opposite of that, you made money.
100%. One of the ironies about those types of baskets, right, is, and I actively utilize those. We have strategies that employ components of baskets that we have created to mimic certain behaviors, right? When you look at those baskets, you'll actually find people who are trying to trade options on those baskets.
Yeah.
And that's almost a perfect illustration of the point that we were making before. Because there is no competition for the Goldman Sachs unprofitable tech basket, for example, if you try to buy an option on that, the premium that you're going to pay is extraordinary, right? You're going to play very, very high implied volatility. Among other things, it's been designed to express a particular type of risk, right? So it has an inherent skew component to it. The tails on the distribution mechanically are very, very wide. That leads to just ridiculously high pricing in options. And I would suggest that that's part of what we're seeing in the market in total, right? Where the factor that we call the S&P 500 increasingly reflects what Americans are doing with their retirement funds.
Mm-hmm. That's an excellent point. You can take snapshots in time too, and this is and we're going to take some questions. If you have questions for Mike, pop them in the queue, and they'll get voted up and down, and then I'll pick the ones that have some good votes. But that's just a week ago, right? Tuesday to Tuesday.
Yeah.
Think about where you could have positioned Tuesday to Tuesday. Then you go back 2 months ago. The VIX 2 months ago today, I believe it was around 19 on the front month.
Yeah.
Now we're at 34. I mean, how do you think about that? Because we're talking about complete vol suppression into a tsunami. I mean, how do you think about that, and how should people interpret what just happened there?
Yeah, well, so part of what I would draw people's attention to, and we wrote about this at Tier 1 the other day, the dynamics of volatility exist in other markets. And so not only do we have volatility in equity markets, which is represented largely by the VIX, That's the most frequent one that you'll see. But it also exists in things like rates. So the MOVE index, which is created by one of my partners, Harley Bassman, you'll have similar components in FX, et cetera. If I look at the volatility in those other segments of the market, they are way elevated versus where the VIX was even 2 weeks ago, right? And today as well, right? If I look at interest rate volatility, it would imply a VIX somewhere around 80, right? Now, do I think that the VIX is going to 80 and that the market is going to crash overnight? No, I do not think that that is what you can draw from this. But what I do think is actually being brought to people's attention there is almost nothing fundamental matters until we figure out what the Fed is going to do, or when the Fed is going to stop the process of hiking interest rates. Like, that is by far the most important driver in the market. It's affecting the currency markets. You heard this from the EU just yesterday, where increasingly they're acknowledging that they're not hiking in Europe or Japan for fundamental reasons, but because they're being forced to respond to the Fed's hikes in the currency markets. If they fail to respond and try to support their local economies, which are under incredible amounts of stress already due to a changing shift of, moving from goods to services in the post-opening of the coronavirus era, you're increasingly seeing these economies under pressure, and they're being forced to respond to it by hiking interest rates, which is doing nothing good for anyone in these economies. And they're acknowledging that this is, again, just a function of responding to the Fed, right? So almost everything right now is about interest rates. And I would argue that you're seeing it today as interest rates began to fall, as the yields began to fall, what's called the rate market rallying, the S&P began to rise, right? We saw everybody came in super bearish. Again, we wrote about this morning. People were stacked up with bearish bets all over the place. And there is a genuine fear, and I actually share some of it, that there is a risk of a crash, right? This feels, in surfing, we refer to water as feeling sharky, right? In markets feel crashy. The market is extremely fragile. That's how it feels. But under those conditions, as soon as the rates market started to rally, the pressure is removed from much of the equity markets. This is not a fundamental story yet. It may become one with a recession. But it's not a fundamental story yet.
Well, to be clear, everybody who's blown up this year needs it to be the next part of the movie. I mean, they really need that. And I went back and forth with Henry on this. That's not what you should be looking for if you're a bull. You should not be looking for deflation and real growth slowing at the same time. That's called quad 4, where the dollar's going up and interest rates are going down. It just so happens that this time interest rates have been going up. By the way, you guys, one thing that Hedgeye Nation is long as of relatively recently, I would say, is a simplified interest rate hedge ETF, which is PFIX. So that's one way to do it as well. So on a day like today, I'm going to be buying that. Why? Because rates, we had an intraday move. So again, we have a bullish upward sloping trend in the 10-year yield, 2-year yield, et cetera, et cetera. And when I get an intraday rates move, I get to buy PFIX. When it goes the other way, I do something else. So we're not like, you shouldn't be oblivious to, to opportunities in the marketplace. You guys have actually created some, I was pinging you the other night. I'm like, what is this one? What is that one? What is this one? because they're not what everybody thinks about, maybe in their 60-40 kind of pie chart framework. But PFIX has worked. CTA, which is another one, has worked well for you guys, which is, I think that's managed futures. Is that right?
That is managed futures, correct.
Right.
So CTA is an abbreviation for Commodity Trading Advisor. The ticker happened to be available, so it works really well. That's a product that has been an absolute home run, that has the ability to go long short commodities. It has the ability to go long short various rate components. And in many ways, that's almost the perfect expression of what you're saying with Quad 4, where it is, effectively long the dollar, right? Without using currency directly to express it.
And what I like about that CTA ETF is that, the commodity component, there are commodities that are bullish trends. I mean, corn, wheat had big breakouts recently, oil obviously as well. if you don't mind, I'm going to jump into the questions that have been voted up here because there are plenty of them. What's the effect, this is from Dan, Mike, what's the effect of auto-callable notes on the VIX? Is it suppressing it? And can you expand on how you expect this type of strategy to unravel during a market panic?
Yeah. So auto-callables are a really interesting component because, again, this is a variant of the retail investor selling insurance to the dealer community. So an auto-callable is a fixed income product or a variable annuity-like product where I buy an underlying exposure to the S&P 500. Let's just make it simple and make it the S&P 500, although you mentioned Tesla. Tesla often plays in these types of components. So I buy the S&P 500. I enter into an agreement in which if the S&P 500 rises by 3%, I get to keep my 3%, but then we tear up the contract, right? That's the reference to auto-callable. When a bond is called, it is forced to redeem. So in this situation, the market rises, the bond redeems. On the flip side of that, you have a downside agreement where you have zero participation in the market to the downside until it falls, and it depends on the contract, when it was entered, et cetera, between 25 and 40%, right? When the market falls 25 to 40%, the contract goes the exact opposite way, but in that situation, you eat the loss. In other words, you have sold a put to the dealer that allows them to say, you know what, I have insurance against a 25 to 40% decline in the market. Okay, so you get compensated for that in the form of a higher yield than you would otherwise receive, right? It's similar to the JP Morgan hedged equity product. We have a hedged equity product, et cetera. They have similar characteristics to it. The unique thing is, though, is because I've sold this put, and then when that put is hit, the contract again is torn up. That actually means that the put itself that is on the dealer's book evaporates when that occurs. So the initial contribution of auto-callables is, if you just imagine what happens, as the market rises, you're constantly tearing up these contracts and entering into a new sold put where you shorted a put on the market down 25%. It effectively is almost always against P. If you just imagine that from the dealer perspective, that's a fantastically valuable piece of paper because it allows them to buy puts of indeterminate tenor that will always be on their books. But if the market starts to fall towards that 25% or 40% down, then the dealer has to start saying, hey, wait a second, if we fall 25% or 40% and we hit this level, now the puts that I own have been torn up and I'm unlikely to get any new ones. So they have to start hedging that downside component as well. Depending on the strikes that were sold, depending on the tenor of the contracts that were entered into, that means that anywhere from down about 20% in the S&P to down about 30%, which is when the 40 strikes would really start to come into play, the dealers have to start buying puts themselves. And that helps to explain the convexity, right? This dynamic of a very non-linear move that we've seen in the VIX in the past couple of weeks. If the S&P pushes significantly below the kind of 3,400 level, there's a very real risk that the dealer community is then suddenly forced in and has to buy puts, and you can see the VIX spike in a manner that is reminiscent of prior episodes like that. Volmageddon from February 5th, 2018 immediately jumps to mind, although it has totally different origins.
Well, the origin is generally, quad 4 economically. So it's a really
well. This is, but Keith, you're hitting on a really important point, right? When you talk quad 4, it's a market behavior component, but when you enter into that, it tends to have an economic dynamic to it.
Yep, exactly.
Right? There tends to be, like, traditionally we would think of what you refer to as quad 4 as recessionary conditions, right? This has rumblings of that. We had negative real GDP growth in the first 2 quarters. The unique feature this time around is that rates are rallying or yields are rising because the Fed is pushing them higher, right? I mean, there's no debating what is actually driving the rates market. It is uncertainty around how far the Fed is going to push higher. We don't know is kind of the easiest answer. And That's why an event like the CPI print coming up on Friday engenders so much fear. Because if we were to end up with a 0.3% or 0.4% month-over-month CPI print, or even a 0.25% relative to the 0.2 that is the expected level, the risk is that the Fed is pushed even further, right? Arguing that we've seen very little response. That's what the market is scared of, that the Fed is going to continue to hike and continue to push it higher. The risk, I would argue, that we really run from here is that the Fed actions that have been taken to date introduce truly recessionary, if not depressionary conditions around much of the world. We're seeing evidence of that, right? Housing has slowed down at a more rapid pace than ever before. Prices are not falling because we're not seeing the same distressed selling component that we saw in 2006, 2007, 2008. But this has rumblings of radically slowing the U.S. economy, and the rest of the world's economy is in much worse shape.
Yeah, this is why I said it with Henry, I say it every day. If you see the long end of the curve, bond yields going down like they did intraday, it's not a buy signal. Last night, South Korea reported the first 10 days of October on their export number, which is about as real time as it gets because there's only been, we're in the 11th day of October. It was down 20% year over year. And that's largely a signal on why semiconductors have been crashing because their exports are primarily semiconductors in terms of what impacted that number. So if you were in the recessionary camp, you shouldn't be like pooping your pants every time bond yields go down like that's the next bull market. That's actually a sign that it's a recession. So, I think that's an important one. Here's a good question. Not to hustle off that one, but there's a lot of different types of questions as you'll tend to get. And actually, this has to do with the recession a little bit. From Nick, this is a top voted question. If and when, Mike, we enter a labor market contraction, how will it impact the passive flow in markets? What happens if passive flow starts to become net sellers instead of net buyers as they've been since the great financial crisis?
Well, it's not only since the great financial crisis, right? So, many of your viewers have seen the charts that I put up that show the flow of money into passive, and it's effectively uninterrupted. We really only have a few months where we've seen them sell. March 2020 is one of those months, right? August of 2015 is another one. That wasn't a function of tightness in the labor market. That was a function of a very simple rebalancing in Vanguard's target date funds. It wasn't tied to the devaluation of the Chinese yuan. That just, was kind of icing on the cake in terms of sensitivity around it. But when they sell, the quick answer is it's happened so infrequently that we don't really know. But the simulations that I've run around this suggest that it could have truly catastrophic effects. Effectively, the same dynamics that we're talking about in meme stocks to the top side can occur to the downside because you've got machines that sell that are being asked to sell at dollar value, not necessarily a percentage of a portfolio, right? That don't have any sensitivity to it whatsoever and have no internal liquidity around it. I mean, one of the statistics that I cite for people all the time is the world's largest mutual fund complex is the Vanguard Total Market Index, right? And it's available in ETF form, it's available in mutual fund form, et cetera. It's somewhere in the neighborhood of $1.6 trillion of assets that are broadly following that fund characteristic, and it's got $100 million worth of liquidity, right? Like, that's insane. It's completely insane. If you have to sell, it has to tie up tap market liquidity. And, the single scariest statistic that came out of March 2020 for me was the quote from Vanguard that less than 1% of their clients sold. Mm-hmm. And, for them, that was a point of pride. Look what a great job they did. And by the way, I actually agree with that. I mean, I was recommending people get in the market and buy as well because there was true terror, there was true panic. It was very clear that the Fed was going to support. But when I heard the statistic, my immediate reaction was like, oh my God, what if it had been 2 or 5, right? I wish I could answer the question, but let me just put it out simply, like, that's bad.
Yeah, really bad.
Very bad.
That'd be horrible. You mentioned, actually, here's a question too. You mentioned target date funds. I've had some Hedgeye employees asking me about this. Because if your payrolls, if your people are on ADP, for example, they're going to be offered like shitty options, but they'll get all the target date options. different people, they just, they get told to buy different things. But this is the first time I think that this has kind of shaken some people a little bit. But anyway, this question from Juan is, Mike, any changes on this target date funds flow in the last quarter? No rebalancing upward impact in either June or September?
Well, so June and September are kind of interesting. If you actually, a great chart, and I would encourage you guys to kind of keep this on your screen, is to do the ratio of VTI, which is the ETF for the Vanguard Total Market Index, to BND, which is the ratio for the Vanguard Bond Market Index. It's a really simplified way of expressing the rebalancing component of the target date funds. And what you'll notice is as compared to trending in one direction or another, it's basically been flat. And that's what's been so painful about this year is that both bonds and equities have sold off.
Right.
And interestingly enough, in those quarters, they sold off roughly proportionately, suggesting that there wasn't actually a lot of rebalancing pressure.
That's interesting. I guess, I mean, there are plenty of questions that I guess I could summarize them in saying, what are the most glaring observations that you have right now in terms of flow in or out that people may or may not be paying attention to?
Well, so I mean, the thing that I pay the most attention to on a regular basis are the actual flows into passive funds. Those have maintained. There are some signs of I don't want to say weakness, but there are some signs that it is less. Right now, perversely, this could be the effect of people like your employees saying, hey, wait a second, I'm not really comfortable with this. But I don't think that's it. The other component of it is when you don't have the rapid growth in wages that we have seen, or when people have perversely high enough wages that they start to tap out their 401ks fairly quickly in the year, you can see reduced flow. One of the things I'm a little bit concerned about is we are starting to see less magnitude to those flows. I don't know whether that's the beginning of a structural shift because so many things have changed. Those who have been watching me talk about this for the past 5 years, I can't believe I've been doing it for this long, talking about this one topic. Remember that I used to highlight people at 70.5. They were what were called required minimum distributions. That was shifted to 72. Now they're talking about removing them entirely, right? All of this is happening with the lobbying dollars being spent by the industry to prevent many of these things. Now, whether that's nefarious and they recognize these issues, or whether that's simply a desire to keep assets under management for a longer period of time, I tend to subscribe to the latter rather than the former. But so many of these things have changed in such a violent way that it's really difficult to know. The most important thing that I would highlight, though, is as the millennials age into basically maxing out their 401ks, the risk is that those flows are less than they have been. We're starting to see some evidence of that. And the second risk is just demographically, people who have heard me talk about this for a very long time. The very old tend not to have passive. They tend to have active managers. Those active managers have been slowly dying on the vine. Today, I would argue that the very first Boglehead retirees are starting to hit and starting to roll into retirement. Does that mean that selling accelerates? I don't know yet, but it's we're seeing. If I were to describe the curvature of the flows, it is weakening a little bit.
I guess that makes sense, but it makes a lot more sense now that you confirmed it. You would expect that to be. You'd expect there to be both a secular and a pro-cyclicality to the tailwind. So if the cyclicality rolls over, that's one thing. If it's blowing into a recession, that's entirely a different thing. Which is, I think the community did a good job asking these different questions, because what they're really trying to do is figure out, like, oh, is that how it happens? When the recession hits, you go from a healthy labor market to a weak labor market. When you go from positive passive flows to maybe less so, and then whammo. It's interesting. One of our good friends that we have in common, and we can't reveal him, is, I'm sure, has told you about this as well. But you also have the flow of, and we have to wrap here, unfortunately, but a potential for $200 billion in hedge fund redemptions in the fourth quarter. Like that's really negative flow. Like that's, there are a lot of different things that can kind of happen in October. I guess the problem, one of the biggest problems is that you're in the blackout period for like 96% of the S&P's buyback program. So it is an interesting environment as always.
Just to add to that point, and our mutual friend would probably say it's blotto, right? The largest funds, the millenniums, et cetera, of the world, have increasingly locked up their capital, increasingly entered into contracts that prevent the withdrawal of more than about 5% a quarter. Ironically, that actually may exacerbate these conditions because it means that a lot of the smaller funds that can't extract those terms become the source of liquidity.
Yeah.
And it's those smaller funds that are typically trying to pick the individual stocks, that are trying to find, the actual interesting names out there, et cetera, trying to invest in the future. I don't want to call them the Cathie Woods of the hedge fund community because that would be an unfair characterization, but they are some of the smarter, more talented people that are doing the more interesting work. The really scary part becomes if they become the source of liquidity, that can have really adverse consequences to a lot of sectors.
Yeah, that's a real important point, and especially when you're looking at a market, just as Mike said, it's not always something fundamental. If a hedge fund is being redeemed and they're blowing out of their top 10 holdings, that's what's happening in those stocks. It has nothing to do with the fundamental, like in that moment in time. It's called liquidity. So thank you for giving everyone the teaching on everything that you know and everything that you do. I know the Hedgeye Nation community absolutely loves you, man.
Awesome. I love them too. Thanks a lot.
A lot of love for Mike Green. Yeah, there's a lot of love for people that do a great job. Now, let's see how many people love the next guest, Mark Cajotes. Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there, subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.